We now want to look at something called working capital management. Now, if we consider working capital management, the first thing I would like to highlight is this. It is made up of a lot of separate areas, all of which are linked to some degree, but from an exam perspective, they tend to lend themselves to unique 6 or 8 markers. So it's very possible that if the examiner is doing a 25-mark question, we could see 4 of these areas arising. But maybe what's more possible is this. Given the lack of marks in the exam, we're not going to get a full 25 marker. We could do, but instead we're going to have 15, maybe 18 marks relating to working capital management. And as a result of the nature of the paper, those 15 or 18 marks could be 2 or 3 distinct areas that could be examined. Now, if we look at working capital management, let's focus on all the different things that may be examined. Firstly, of course, we could have treasury. Now, you could argue that treasury is nothing to do with working capital, but it tends to fit rather nicely into this area, so I've slotted it here. Secondly, we have to consider an overview. You know, the big picture, looking at working capital as a whole and how we manage it. Thirdly, a very popular area with your examiner, funding. How do we finance the working capital? Do we finance it short-term or long-term? And then, once we've looked at the big picture items, then we can look at the specifics. And of course, see how we would manage receivables. Or, I suppose the other side of the coin there, payables. Or inventory. Or cash. So when we're looking at working capital management, we may get the big picture, we may get the detail, but the key with it is we've got to be ready to pick up something here. As far as I'm concerned, working capital management is one of the less theoretical areas. And the key is to be able to respond very quickly to the information that's given to you by the examiner. Okay, let's start by looking at treasury. Now, what is the treasury function? Well, my view is this. The treasury function is simply the relationship between the company and the outside world with regard to all financial matters. I.e., people working in treasury will be the face of the company in terms of the shareholder, in terms of the banking relationship, in terms of the debt holder. And maybe they will deal with other issues, such as foreign exchange. From that perspective, you have to be able to define what treasury is. But in simple terms, there are likely to be 2 basic questions that are always asked in this area. The first one is this. Should we centralize or decentralize? Now, if we're looking at this idea, the suggestion goes something like this. We have 2 choices. We can either have a single treasury function in head office, or we can have a smaller treasury function in each division of the organisation. I suppose the reason why we're asked this question is simply this. For a lot of companies, at least in recent years, the idea has been to push back as much of the management resource to individual divisions. So, if that's the case, should we push the treasury function? Now, the argument is simply no. What we identify is this. The treasury function is one of the few functions that bucks the trend. We should look to centralise treasury for these sorts of reasons. 1. If we are looking to borrow money, it is normally easier and cheaper to borrow it in bulk, centrally, than to allow each division to borrow on its own. The reasons for this are, of course, the economies of scale, but borrowing more rather than less. But if we look at the company as a whole, we have a better asset base, and from that perspective, we also benefit. So, borrowing is cheaper. Secondly, if we have money to invest, again, we get a finer or better rate by investing a large amount rather than a small amount. So maybe it makes sense to pool all the funds available within the organisation within a single bank account. Thirdly, when we're looking at risk, and of course most of financial management is about risk, by looking at the big picture, we are able to better understand the risks associated with whatever strategy we are taking. For example, if we were looking at foreign currency, one division may spend all its time selling to the US, and therefore it has dollar receipts to deal with. But if we look at the company as a whole, we may find another division where it spends all its time buying from the US, therefore it has dollar payments to make. If we look at the big picture, we could net receipts with payments and therefore reduce our overall exposure. So these are the sort of arguments that we could use to centralise. There are more, but know at least 3 or 4 of them in order to be able to answer this area. Of course, there are reasons why you may wish to decentralise. You know, the idea that you may be able to specialise in the specific needs of a division, or maybe you could respond more quickly to the specific requirements of a division. But the general consensus in this argument is that we centralise rather than decentralise. Get that one sorted, you've got your 4 or 5 marker in the bag. Then we look at the other side of the coin. The other one is, should we operate the Treasury Department as a profit centre or a cost centre? Now, this one is slightly more tricky. You see, the argument is that by operating the Treasury function as a profit centre, we have a substantial number of benefits. If we operate the Treasury function as a profit centre, the Treasury will have to charge for its service to each division, and it could sell its service outside to somebody else. Now, what are the benefits of accurately charging to each division? Well, you could say it cuts both ways. On the one hand, it rations the requirement of that service in the divisions. If you're being charged for something, you're that much more careful about how much of it you use. The other issue is this: each division is well aware of the costs of the internal department, and therefore they have an understanding as to whether the department is doing a good or a bad job, because I suppose they could benchmark the internal service against an external service. And as I said, it's possible for us to sell this service outside. And if we're selling this service outside, we're going to gain some money for the business, although that's unlikely for any but the very largest of Treasury functions. Finally, you could argue that it's a good thing because it allows individual departments to decide how much risk they're willing to accommodate internally and how much risk they will sell off to a bank. So these are the sort of advantages of the profit centre. And from that perspective, you could say, fine, we should always have a Treasury function as a profit centre. The issue is this: if you make the Treasury function a profit centre, you encourage it to make profits, not surprisingly. And one way for a Treasury function to make profits is to take risks on itself, i.e. speculate rather than simply deal with transactions. And history is littered with Treasury functions, either of local authorities or companies, who have tried to do this. And as a result of the risks going bad, the company has suffered severely or even failed. So what we could say is that the profit centre has some benefits, but to be safe and to reflect the reality of smaller treasury functions, realistically, a cost centre is probably a safer way of dealing with things. So, you will be required on occasion to discuss treasury. I don't think it's a difficult area. And the key feature is to have these two arguments ready. If you have these arguments ready, you'll have no problem picking up the marks. Let's move on. What I want to look at now is to look at the overview for working capital management. Now, if we're looking at working capital management, or WCM, you and I know that working capital is made up of current assets minus current liabilities. That's the easy bit. And all I want to do is to understand the basic premise of what it is I'm trying to do here. So from an overview perspective, let's just remind ourselves of the sort of things that are assets and liabilities. If you remember, current assets will include such things as inventory, or stock, as I tend to call it. Receivables, or if you wish, debtors. Do we still call them that? And of course, we have our bank or cash account. These are the sort of things we can manage. There may be other things in current assets, but they are just financial accounting mumbo-jumbo, you know, things like accruals, prepayments, that sort of nonsense. These are the only things that we can manage. Looking at current liabilities. Of course, we have payables. And we may have short-term borrowing, you know, a bank overdraft. Now, all I want to do here is to get some basic ideas out of the way. And the first idea is this. When we come to manage our working capital on a day-to-day, week-to-week basis, we normally look at managing receivables, payables, and inventory. That means that the bank balance, or the bank overdraft, effectively is the balancing figure after we've managed receivables, payables, and inventory. I think that's quite a powerful idea. So this is the balancing figure. This is whatever it becomes after we have invested money in inventory, invested money in receivables, and, received effectively money from payables. Of course, we need to manage it, but we wouldn't look to micromanage cash on a day-to-day basis. And maybe this is something that we see when we look at cash budgets later on. The second idea that I want to talk about is this one. If we were to look at current assets, and I just said to you, good or bad, what would you say? Well, I've got a feeling that most of you would say good. An asset, something that we own, that must be good. But the issue with working capital is this. Current assets require financing. Therefore, the higher the current assets, the higher the cost of financing them. And the higher the cost, the lower the profit. So, all I like to think about is this. When we look at current assets, they require funding. And therefore, in very simple terms here, our mindset is this. Our aim must be to minimize the amount of current assets. Oh, I know what you're going to say. If we minimize our current assets too much, we won't have enough stock, we won't have enough receivables, we won't have enough cash. I will agree, we need some. But in the interests of efficiency and profitability, our basic mindset is to hold as little as we can without damaging the company. Okay. That means, of course, that if we're going to look at current liabilities, well, you could argue that liabilities, something that we owe, is bad. But if we look at payables, is it bad? You could argue that if we could negotiate extended credit, that is a good thing for a company because it delays the time before we have to make payment and therefore effectively becomes a means of funding the business. So, if you wish, it provides funding, short-term funding, but funding nonetheless. And so you could argue that from that perspective, we wish to maximise our payables. Again, I know what you're going to say. Yes, we must pay our suppliers. If we don't pay our suppliers, then we're in potential trouble because our suppliers will stop supplying us. Our suppliers will take us to court. We will lose our reputation. But in simple terms, I want you to remember that from a working capital management perspective, we don't want that much in the way of current assets. And we may be willing to accept a higher current liabilities. So, very simple perspective, very straightforward, but I think incredibly powerful. Now, if that's the case, let's move on. And what I want to look at is the overview. If we look at working capital as a whole, what are the key considerations? Well, I think we've already said them, and we're going to say the same thing again and again through working capital. The issue is simply this. We want enough working capital, but not too much. Okay? It's a balancing act, if you wish. We want sufficient working capital to make sure that we pay our bills on time. But on the other hand, we don't want too much, because working capital costs us money. The higher the cost, the lower the profit. From that perspective, there are two overview considerations. On the one hand, profitability. And the other one, liquidity. And any overview question will look at the balance between these two. The best questions will look at both. But a lot of questions, particularly given, I've already told you the max is probably going to be 6 to 8 marks, we will probably focus on one or the other, but not both in the same question. So, if we're looking at profitability, what we're looking at is the level of working capital. The total amount of working capital invested. Now, I've already said to you that on a day-to-day basis, we are looking to measure three things: receivables, payables, and inventory. Those are the balances that we are attempting to manage. And you could say, well, hold on a moment, just going back to what we've discussed already, you could say that our focus is inventory plus receivables minus payables. This would give you some indication of the money tied up in working capital. Of course, you need some sort of cash balance as well. But remember, the amount tied up is receivables plus inventory minus payables. Now, if that's the case, what are the key determinants of the level of working capital? Well, in overview, remember we will talk about the detail a lot later. We could say that the level of working capital is dictated by two basic issues. One is the level of activity. In simple terms, if we expect sales to rise by 10%, we can reasonably expect a 10% rise in working capital requirement. We'll look at that in a moment, not a big issue. The other issue is the operating cycle. We can call this the operating cycle, or the cash cycle, or the working capital cycle. It has many different names. The operating cycle is simply the length of time it takes for cash to circulate within the business. In simple terms, the length of time it takes for us to pay our suppliers to the point when we receive monies from our customers. The shorter the period of time, the less working capital. The greater the period of the time, the more working capital. We'll come back and discuss these in more detail later. When we look at liquidity, what we're looking at here is, are we solvent? Are we able to pay our bills? Because if we're not, we risk running out of cash, failing as a business. Now, this leads us to the over-trading argument, and we will come back to talking about over-trading later on. And when we look at the over-trading argument, there are specific things that we could measure. Now, I will say that my consideration is that when we look at this sort of question, we want to be narrow. The reason is that if you look at past exam questions from your examiner, he would definitely look at what I'm looking at here, but he tends to go for a much more general question. And the fact is, in the exam, you won't have time in that 6 to 8 marker to get everything out. So I want you to get the real quality things out and leave the more peripheral things out of your answer. Okay? Just a view. Now, if we're looking at over-trading, what we have to consider here are the reasons for over-trading and the measures. Now, we'll come back and discuss this later on. But all I'm trying to get at is that there are two basic questions with over-trading. One, how did we get here? And two, are we over-trading or are we not? Is this a very bad position or is it a sustainable position? Now, of course, these two are linked, but they are not the same. So please make sure that you're very careful in the exam to understand what the examiner wants of you. So, these are the basic two issues in overview. Not exactly rocket science. Nothing about working capital should be difficult. Let's move on and talk about what sort of things affect the level of working capital. We've talked about the idea that we want to minimize working capital, but at the same stage have enough. That's fine. But of course, individual companies will have differing amounts of working capital. And to a certain extent, the amount of working capital that a company has more relates to its industry type, or its customer base, or the degree of uncertainty than anything else. For example, if we look at industry type, why would differing types of industry have differing needs for working capital? Well, maybe the first example is this. If we separated industries into three basic criteria, we had manufacturing, retail, and service industries. What could we say about the amount of inventory or stock required? Well, if we look at a service industry, how much stock or inventory do they need? Probably very little, if anything at all, because they're selling a service rather than a product. If we were looking at a retail operation, how much stock would it need? Well, of course, it would depend on the type of retailer. If we're looking at a food retailer, the perishability of food would suggest that they would have to buy and sell the goods very quickly. If we were looking at maybe a more specialist retailer, maybe they're looking to hold 1 or 2 or 3 months stock. So, retailer probably needs considerably more stock or inventory than a service. And then when we look at manufacturing, Well, we'd probably suggest that a manufacturing company would require considerably more inventory or stock than the retailer, and definitely more than the service operation. Because if we look at the manufacturing industry, we would say, well, hold on, they need raw material stocks, they need finished goods stocks, oh, and in between they need some work in progress. Oh, and in addition to that, they may well need engineering stores to keep their machinery going. As such, the amount of stocks associated with manufacturing operation are probably far higher. And of course, if we looked at specific industries, some industries will have a higher requirement, maybe for receivables than others. Maybe simply due to the nature of the type of business that they're in. So, if we talk about industry type, maybe we could talk immediately here about the inventory level. And maybe the receivables level. Secondly, we could talk about uncertainty. Most of you have come across the idea of just-in-time. And the idea of just-in-time is that we have zero stock. Why can you get away with zero stock? Well, you don't need stock if you're guaranteed to be delivered your material when you need it. So, if you have certainty of supply, fantastic. You don't need to hold the inventory or stock. But as soon as there is any uncertainty within this operation, you need to hold some inventory just in case the delivery doesn't come in time. So, the more uncertain the delivery, the more you need to hold. Thirdly, the level of activity. If we were to look at level of activity, well, I'll tell you what, let's just go away from here and just think this one through. We could look at level of activity in terms of sales. Let's just say sales go up by 20%. What would we expect to change within working capital? Well, yes, all else being equal, if sales go up by 20%, wouldn't we expect receivables to change? All else being equal, couldn't we say, if sales go up by 20%, receivables will go up by 20%? Does that make some sense? I think so. And hold on a moment. If sales go up by 20%, what's going to happen to purchases? Well, again, if we look at sales going up by 20%, all else being equal, wouldn't we expect purchases to go up by 20% as well? Okay. And if purchases go up by 20%, what else can be affected? Well, yes, it really is this simple. Payables. Again, all else being equal, that would rise by 20% as well. Oh, the one thing we've forgotten is inventory. Now, the question mark is this. If sales go up by 20%, do we need more inventory? And the answer is, don't know. Maybe yes, maybe no. But I think we would generally accept that if the level of activity goes up, we would need some more stock. Yeah? Whether it's proportionate or not, I don't know. But of course, that's too complicated for an exam question, so what we typically guess is that inventory would rise equally. Now, if that's the case, my guess is this. The sum of the increase I'll try that one again. If that's the case, my guess is this. The sum of the increase in the current assets is likely to be higher than the increase in the current liabilities. And as such, the need for working capital will rise. This is a very important, very basic point for us to remember for later on. So, we've had a basic look at the overview. Now let's just think a little bit more detailed as to exactly the issues in the overview. So let's look at profitability. I said to you that profitability, what we needed to look at was something called the operating cycle, also known as the working capital cycle or the cash cycle. And this is a very simple thing to calculate, because when we look at the operating cycle, all we do is take receivable days. You tend to see it in the books as receivables period, yes? Plus inventory days. You tend to see inventory turnover period minus payable days. Now this is a very simple calculation, but it will come up because, of course, it's one of those fundamental things that the examiner has to examine on occasion. In simple terms here, in order to get the days, we have a very simple formula, or if you wish, ratio to calculate. What we do is we take the balance sheet measure. Yes, I know, to me it's still a balance sheet. You may wish to call it, what? A statement of financial position or something like that. We divide through by the P&L, should I say income statement measure. What's that? Statement of comprehensive income to you maybe, and we multiply by 365. You see, what we're trying to suggest is this. The balance sheet, yes, it reflects a balance at a point in time. And we're trying to see for what period of time that balance relates. If you look at the income statement measure, that reflects the need over, well, typically we calculate an income statement over 1 year. As such, we're saying we've got a balance that we're spreading over that year. How many days does it relate to? And of course, to express it in days, we multiply by 365. So shall we look at a Mickey Mouse example to see how it works? I don't think it's ever going to be an issue. If we were to have our income statement information, and all I'm going to give you is the sort of information you are likely to get in the exam, okay? So nothing too complicated. What we would have is sales or turnover. Should we say what? $600,000? Yeah? And we would have maybe gross profit of 200,000. I'm sure the rocket scientists amongst you have appreciated that the cost of sales must be 400,000. Then, when we look at the balance sheet, statement of comprehensive income, statement of financial position. Who invented these ideas? If we look at the balance sheet, we would get some sort of receivables balance. We would get some sort of inventory balance. And we get some sort of payables balance. And I'm sure it would be laid out in a slightly more sophisticated manner than I am showing here. Let's suggest the receivables balance is $100,000. The inventory balance is $80,000. And the payables balance is $120,000. So, with these numbers, we should be able to calculate the appropriate operating cycle. So, in simple terms, if we want our operating cycle, Well, it's a very simple thing, this, but can I suggest that if you don't know how you're going to lay things out, always make sure that you have a column down the right-hand side of your page. And everything that we want in there is just going to end up being shoved there. Okay? If we were to look at receivable days, I think we'll get away with that. Should be receivables period. Couldn't we say, what? We've got 100,000 divided through by 600,000. I've taken receivables in relation to sales because, of course, receivables are based on revenue, the sales measure. And we multiply by 365. Inventory days. Well, we said inventory was 80, didn't we? 80,000? Inventory is a cost. As such, it won't relate to the revenue. Instead, it will relate to the cost of sales. And if you look above, what did we say again? We said that the cost of sales must be what? 400,000? Not exactly rocket science. So, 80 over 400 multiplied by 365. And then finally, we offset our payable days. 120,000 divided through by. Now, if we were looking at the best measure for the statement of comprehensive income, the income statement, payables relate to purchases, and we would want to use purchases. But the fact is that we're normally not given purchases, and therefore our only choice is to use cost of sales. And that is all we have to calculate. Once we've got that, we've got our operating cycle. Well, okay, let's see what we can get out of this. Receivable days. We run through the numbers, we get 61. Inventory days, 73. And payable days, minus 110. So if we were to look at the operating cycle, the length of time between us paying our suppliers and we ourselves being paid by our customers, we would see something like 24 days. My question to you is that good or is it bad? Well done. Don't rise to the bait. We don't know whether it's good or bad. It's highly dependent on the type of industry that we're in. The only thing I could say is this. If, let's just say, I were able to halve the operating cycle, what impact would that have on working capital? Well, all else being equal, if I halved the operating cycle, I could effectively halve the need for working capital. So from an overview perspective, this is a very powerful tool. When you are in charge of the finance department of a large company, you won't have time to do all the bits and pieces. But one thing you can keep a measure of is this. Because, of course, if you can bring it down in some way, you can make some very real savings in working capital. If, however, it's creeping up, you can see that you're becoming less and less efficient. And because you're becoming less and less efficient, that is damaging your bottom line. So, we look at the operating cycle, working capital cycle, cash cycle, and it gives us an opportunity to understand the relative efficiency of one company to another. But of course, it only makes sense to consider this sort of number if we are given some form of industry sector average. Right, so we've looked at the efficiency, profitability side of things. What I want to look at now is the overtrading issue. This question must arise on a semi-regular basis. One of the key issues for any company. just so we know what we're talking about here, another way of describing overtrading is to talk about undercapitalisation. And if I were to describe overtrading, I would always try and talk about it in two ways. The first way I would describe it is simply this. The permanent funding of the business is less than the funding needs. What we find is simply this. The permanent funding of the business, you know, the debt and the equity has not kept pace with the needs by the business as a whole. And typically we find one of the reasons why this happens is because the company grows and grows and grows, but nobody thinks to increase either the amount of share capital or the amount of permanent debt. So, permanent funds are less than the funding needs. A second way of describing overtrading is simply this. We are unable to pay suppliers as they fall due. You see, what I like to do here is I like to look at overtrading from two angles, the big picture and the implication. Because if we say this in the exam, the examiner will have an understanding that we know what we're talking about. Now, if we're looking at overtrading, we want to look at reasons why this may arise. So, if you're considering the reasons, why is it that we get into this sort of mess? Well, I think we've said a couple of times already, one major reason is a fast growth in sales. Why would that adversely affect working capital? Well, the issue we've already seen is that if sales grow quickly, we have an increased need for working capital. We probably also have other tensions because we'll probably need other, what? Non-current assets as well. So we find that there is greater and greater need for assets. And if we don't have additional permanent funding, we risk running out of cash. So, a fast growth in sales is a classic reason for overtrading. The other main reason is simply this: loss of permanent funding. You know, the idea that the bank may withdraw support. Or maybe we have some form of loan notes that require to be redeemed and we are unable to refinance them in some way. As a result of this, suddenly we find a black hole in our financing. Now, I suppose we could look at other reasons why this happens. You know, what about a large fraud comes to light and we find that somebody's stolen everything? I suppose potentially that could have the same effect. But if I were to look at the basic reasons, these are the two that I would focus on. Now, let's look at the measures. How do we assess whether we are overtrading or not? Now, remember what I said before. When it comes to measures of overtrading, I want to be narrow because, of course, overtrading will affect all parts of the business. But what I'm trying to say here is this. What are the measures that I would look for, particularly comparing one year against the next, that would suggest to me that we are overtrading? Okay? So that's really, I'm trying to keep it very narrow because that means that the quality of our answer will be very tight. Because I'm not convinced that the examiner's answers that look at lots of different things are necessarily the best answers you've ever seen here. So, if we're looking at the measures, the first one, not surprisingly, would be to look at our liquidity ratios. Absolute must. You know the liquidity ratios. Everybody remembers them. What have we got? We've got the current ratio and we've got the quick ratio. The current ratio is current assets over current liabilities. The quick ratio, current assets minus stock, inventory over current liabilities. Okay. So, we've got our liquidity ratios. No problem. We'll come back and talk about the current ratio later on. If you look at the quick ratio, all we're looking at there is the numerator, current assets minus stock, showing us our liquid assets. And I suppose the argument is, do we have sufficient liquid assets given that current liabilities may fall due all at the same point in time? So, liquidity ratios, and of course what we would want to do is to compare them against the sector average. And your examiner is very good normally at giving you some form of sector average. Then we move on. We've got our liquidity ratios. What about our cash balance? If we are overtrading, we would expect substantial pressure on our cash balance. We would expect a move from surplus to deficit, from having cash to being in overdraft. Now, being in overdraft in its own right is not a major problem. A lot of companies operate on the overdraft. But if the overdraft is very high, or if it's increasing very much, we have to be very concerned about this. So, all I would suggest here is that when we look at the cash balance, we're looking at the change in the cash balance and the balance itself. Okay? Not exactly rocket science, but again, we've got to have something to say. What else could we look at? Well, I like to look at payable days. Remember, we're focusing in here on our overtrading. So why do we look at payable days? Well, payable days are the length of time it takes for us to pay our bills. So if payable days were extending, what could that suggest? Well, yes, if payable days are extending, it could suggest that we're having greater and greater difficulty paying our bills. Likewise, if payable days are high in relation to the industry average, that may suggest that we are abusing our credit terms, not paying people on time, and therefore maybe at risk that they will take us to court. So again, we look at the change and we look at the balance. And I would sincerely hope that our examiner would give us the sort of information that allows us to do a comparison. You know, some sort of industry sector value and maybe last year's figures as well. So, these are the three core aspects. We could, of course, look at the level of activity. You know, sales. Because in a lot of questions, change in level of activity is a base measure as to whether we're overtrading. By looking at a change in the level of activity, we couldn't say, yes, we are overtrading, or no, we are not. But we could suggest that it's maybe far more likely that we will overtrade. Okay? And I suppose you could always focus on the funding. You know, you could always look at the share capital and the debt. Because if there is a sudden drop in the share capital and the debt, that could be the reason why. Okay? So, these are the sort of things that we could look at. And I will say again, I have necessarily looked very narrow here. There are many other things that we could have talked about. We could have talked in general terms about profitability. We could have talked about the impact of receivable days and inventory days on this. But I'm saying to myself, if I were to assess overtrading, all I want to know is, are we overtrading or not? And to know that, these are the sort of things that I would focus on. And if we were to make it super narrow, I really would want to focus 1, 2, 3. That way, the examiner knows that it's a very tight answer in relation to a very specific question. I think it's time to look at a question. Now let's look at the funding of working capital. A real favourite of the examiner. If we're looking at the funding of working capital, we have two basic choices. We can either fund working capital short term, or we can fund working capital long term. If we talk about funding working capital short term, I suppose we're talking about funding it via payables or overdraft. If we were to fund it long term, we're talking about, I suppose, long-term debt or equity. If we're looking at the relative advantages of long and short-term financing, there aren't that many. We must get them out because this is a very popular topic with the examiner. So, short-term. The first argument is this: short-term funding is cheaper. And we have to say why. It's due to the principle of liquidity preference. Now, I can hear howls of derision from you guys. You're saying, hold on, is short-term funding cheaper than long-term? No, it's not. But what I'm looking at is one theoretical perspective. If I asked you a question, the issue is this: would you rather lend money for a day or for a year? Well, I think most people would rather tie their money up for one day than 1 year. And that's because we would want the money back sooner than later. As such, the overall return for tying your money up over a longer term is higher than the return if you tie it up over a shorter term. That is what liquidity preference means. It means that investors prefer to be liquid. Therefore, long-term funding should offer a higher return than short-term funding. Be able to describe it to the examiner. Secondly, it is flexible. If we look at an overdraft, the key feature of an overdraft is this. Although you may have an overdraft of £1 million, you only pay interest on the balance that you use, which is critical when it comes to the temporary need for funds. We don't want permanent debt of 1 million if we're only using 200,000 of that debt at the moment, because the cash that's sitting there, 800,000, will still be costing us financing cost. So it's flexible nature. You only pay for what you use. Very important, very simple. And of course, you could just take the path of least resistant argument and say this: it is far easier to arrange. All you have to do is to ring up the bank manager, have a chat, he checks your books, you get your bank overdraft. Far easier than raising permanent long-term debt, or issuing shares. So, based on this, we would be inclined to fund our working capital short-term. But it has one critical disadvantage, and that is when you look at an overdraft or you think of payables, payables have to be paid as and when an overdraft is repayable on demand. That means that the bank manager could, at least in theory, ask for the overdraft back at any point in time, something that's been evidenced by the recent credit crunch. The key advantage of permanent funds is their permanency. They are secure over time. And you cannot overemphasize that importance. Also, linked to that, less frequent replenishment means that we don't have to continuously worry about replenishing our finances. So these are the arguments that you get backwards and forwards. Not exactly difficult at all. But there's a little bit more to it than this. If we look at the funding of working capital, we have to think of the components within working capital. So if we were to plot over time our current assets, what we could do is separate our current assets into permanent current assets. I don't mean that we never use up the stock or we never receive the receivables. All I mean is that there is a permanent base of working capital, current assets, below which I don't expect to go. And then secondly, above that, of course, depends on a whole host of factors. What we would expect is some sort of fluctuating current assets. You know, the idea that stock, inventory, and receivables bounce up and down with the seasonal nature of business and other factors. And all we have to remember is this. When we look at fluctuating current assets, we want to fund those short-term. We want to use short-term funds here simply because we can take advantage of the flexible nature of the overdraft. And therefore we don't have funding in place when we don't need it. But the argument that we have to be ready for is this one. How do we fund our permanent current assets? And the issue is we may fund it short-term or we may fund it long-term. If we fund it short-term, this would be described as an aggressive policy. The idea being that we fund it short-term to take advantage of the lower cost of short-term funds. However, there is a severe risk here because short-term funds are repayable on demand. The alternative is that we adopt a conservative approach. And with a conservative approach, we fund it long-term. It may cost us a bit more. It may be more difficult to raise these funds. Yes, more complicated. But the great advantage of the conservative approach is we know the funds are there. Now that's the argument. If you're talking about funding, there are two basic issues. One, the use of the funding, and two, the relative advantages of the funding types. To me, this is a lovely area. If we can get those two ideas out, we can easily score the marks. And I will say that this question has come up again and again. I would guess more frequently than 1 in 3 exams. As such, be ready for it. Be ready to nail those marks.